Online 2025, enter an invoice selling inventory using a perpetual inventory tracking system. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 project file we set up in a prior presentation. Let's open up those major financial statement reports like we do every time. The reports, of course, on the left-hand side. Under the standard reports, the favorites, right-click in the balance sheet to open a link in a new tab. Right-click in the profit and loss, otherwise known as the income statement, to open a link in a new tab. Tapping to the right, close in the hamburger, changing the range for 1 month time frame, 01/01/25, 01/31/25. Run it so we can refresh it. Tapping to the right, close in the hamburger, doing this again, even though there's nothing in the income statement yet, but we're getting there. We're going to actually start selling stuff. 01/01/25 tab, 01/31/25 tab. Run it to refresh it. Nothing's in it as of now, but if I go to the balance sheet, you will remember the process. We set up our beginning balances, then enter transactions often needed when setting up a new company or growing a business, that being getting the capital or cash, which possibly could come from the owner. So we entered a deposit increase in the checking account from the owner, and then a deposit increase in the checking account from a loan we took out from the bank. Then we purchased property, plant, and equipment, long-term assets we need to help to generate revenue. Then we're working on buying the inventory, or we purchased some inventory, guitars in our case. Now we can finally sell the inventory. So that's going to be the process. We're going to actually generate some revenue selling some inventory. Let's go to the first tab over here, hitting the plus button. Remembering that as we sell, now, first of all, we're not going to start off by selling the inventory that we linked to the purchase order and then to the expense form in the past. We'll do them shortly or later, but for now, we're just going to enter a normal journal entry as though someone came into our guitar shop, picked up a guitar, and wanted it. Although we're going to first start with an invoice, which means they're not at the cash register. We're going to basically increase the accounts receivable. So you will recall when we deal with inventory, we're going to have to basically buy the inventory, which we already did with the purchase order over here. And then with the paying for it with a check or expense form. Now we have the inventory and we're going to sell the inventory using an invoice form. So instead of the form used at the cash register, which would be a sales receipt, invoice form, as though we're basically increasing the accounts receivable instead of recording the payment at the point in time of the sale. As we enter this, if we're tracking inventory at the same time, using a perpetual inventory system, this will not only record the revenue, which we'll see on the invoice, but also the item will track the inventory item, recording the expense related to it, as well as the unit decrease in inventory. Let's check it out going into an invoice. So we have kind of the new look and feel of the invoice here. I think their test drive still has basically the older look and feel of the invoice. The data input will basically be the same, however. So we select the drop down. We're looking at our adding of the customer. We're going to be choosing a customer that it's already been set up for us, that being Anderson Guitars, Mr. Anderson. So then we're going to have the information populated on the bill. And they have the location for Mr. Anderson. And then the invoice number is going to populate automatically. It's starting at 1001, a 4-digit number. Then we have the terms. The terms are basically when do we expect to be paid. Net 30 is kind of standard, but you can use other terms as well. In other words, if I'm selling something or if I was to have a service item that was provided, then when we send out the invoice, the question is, when would we expect the payment to be received before we would see it as a late payment? And so we're going to stick with the 30 days as the default. So if I enter this as of, let's say, 01/16/25, 30 days later will be 2/15/25. So it's going to just pick up the 30 days because of the net 30, and that will populate the due date, which of course will be important when I'm trying to collect on the invoice, I want to see if it's past due so I can then follow up on our collection process. All right, so we're not going to be putting any tags in. So then we're going to go down to the products. So now we have our products down below. We've already set up our product items. So I'm going to start typing in an ELP. So we want an ELP, which is an Epiphone Les Paul. I'm going to pick one of those. Noting, it's going to give me a note on the sales tax, but I think we'll be okay. So we have an Epiphone Les Paul. We have the quantity. Notice that when I'm on the quantity field, it gives us the quantity on hand, which makes it a little bit easier for me to make sure that we have the units on hand, at least according to our QuickBooks system when using a perpetual inventory type system. Now note, the idea here is to have the data input already in there to make it really easy so that I can have someone that really doesn't know anything still be able to populate the invoice. So you can hire someone, you know, not all teenagers are stupid, but you can imagine a distracted teenager still being able to do the input even though they have no idea of what is actually being recorded, because we set up the items to be input very easily, even though this transaction, when we record an invoice, particularly one that tracks inventory, is actually fairly complex, but the data input is fairly easy. All right, so we're going to say 5 units of those at $500. That's the sales price, not the cost. Now, the system knows the cost, but we're going to be populating on the invoice the sales price, just like you would if you were to check something out at a self-checkout at like a supermarket, in which case it will show you the cost, of course, because that's how much you're going to have to pay, but we'll also be recording the cost of goods sold, the expense related to the sale on the system side of things. We're going to say it will be taxable, so we'll apply the tax to it. So that's checked off, automatically is checked off because of the item that we have. So let's have an EPR, I think is what we want, EPR. And that's going to be an Epiphone Riviera. Let's pick that one up. And let's say that we sell one of those at $550. So that's $550, sales tax applied to that one as well. And then we're going to say the last one is an EPSH. An EPSH, picking that one up. So that's an Epiphone semi-hollow body. And we're going to say that we sell one of those. They're going to be sold at $400. That's how much we sell them for, not the cost. $400, and that comes out to a total of 3450. So 3450. If we had any more items, we can add more items so we can clear all the files here if was necessary. And so then down below, customer payment options. Now note that when you're dealing with the invoice, we're most likely these days might be like emailing the invoice to people, in which case we want to make the payment of the invoice as easy as possible. Now we might have a bank, our bank account, for example, having electronic transfers. So we might have that set up through our bank, which means we're going to provide the payment information to them to give us an electronic transfer. However, if we set up the electronic transfer with QuickBooks, banking system, then it might be a little bit easier to connect it to the invoice. So that's one option you might want to look into. Other payment options to be able to accept like credit cards from the invoice, allow them to just click on the link to the invoice and pay you with a credit card or something like that. Again, you can look into the setup options to get those payment options in place, but just remember some options are going to cost you more money than others. In other words, if you're getting paid with an invoice, a credit card, you might have to pay the fees of the credit card company. An electronic transfer might be the cheapest way to go oftentimes. And then again, you can look into other options such as paying with PayPal or something like that. Although the problem there, of course, is that a lot of people don't have PayPal, right? So then they can use their credit card to pay you with PayPal, but then you got to deal with the credit card fees and so on and so forth. So keep those payment options in mind. The trade-off is usually you can add more payment options to make it as easy as possible to collect on the invoice, which makes it more likely that you might collect on the invoice. But the more payment options you provide, the more likely they will pick one that charges you fees, such as a credit card, which means you're going to have to pay fees and you're going to get less revenue or have the expense of the credit card payments. So so we have here, let's close this out. We have tell your customer how you want to get paid. So again, you can go into this information and get into more detail on your payment options. Notes to customers, if we want a note to the customer. Internal customer notes that are hidden. These are notes that would be on our side that we can see but will not be on the customer. Memo on a statement, which is also hidden. We can add attachments, which you don't typically have on an invoice, but you could add them if needed. You can print or download. You might want to take a look at the preview of it, because and if you were to give it to somebody, then you might download it or print it as a PDF so that you can email it if you wanted to provide it that way. So this is a form that you can customize. So if you email it to them and they open it up in a PDF format, it's going to look like this. Because it's an external form that the clients will be receiving, you might want to put your logo on it and stuff like that. We have another course or section that gets into the customization process. Let's close this back out. Right now, we're just working on recording the transactions. We have more actions, make a copy. Sometimes if you have a long invoice, that could be useful. Create a credit memo if you needed to make it into a credit memo because there was a return, delete, void, transaction journal, and audit history. Okay, so now on the taxes, we set up a tax option for the automatic option, which would check the location and bill by the location. But we also set up the generic 5%. I want to use the generic 5% for the practice problem to show a generic consumption tax system without being specific to a particular location like California. If you don't have that, you could add the tax rate here and manually put in the tax rate if you want, just so you come up with the same numbers that we have on our side. So what's this going to do? What's this transaction going to do then? Let's pull out the trusty calculator. I'm going to say calculator. Where's my trusty calculator? Boom. All right. So let's make it a little smaller here. It's too big. You're too big, calculator, for crying out loud. So we're going to say we're charging $3,450. $3,450. We have a 5% sales tax, so that's going to be 3,450 times 0.05. That's going to be the $172.50. That means that we need to collect the sales tax, that plus the 3,450 for a total of the 3,622.50. Notice that this is all populating by itself if the data input has been done properly and if the items and sales tax has been set up properly, which we did in a prior presentation. If you want to get directly to that bottom line number, we could, of course, just take the 3,450 times 100%, 1, plus 5%, 0.05, 105%, 1.05. That gives us to the 3,622.50 basically directly. So what's this going to do? It's an invoice. So when we think of an invoice, we think accounts receivable is going to go up. So we're not getting paid yet. We're going to get paid later. We'll have to collect on it. Accounts receivable goes up by the full amount that they owe us, $3,622.50, which includes the sales tax, a type of consumption tax. The other side's going to go to revenue, but not include the sales tax, only being for the 3,450, how much we sold it for. The difference of the sales tax, $172.50, is going to go on the balance sheet in sales tax payable, a liability account, which will be going up. It's off the income statement. Also, we're going to have a decrease to the inventory, not for the dollar amounts up here, but driven by the items which knows the cost of the inventory. These are the sales prices of the inventory. And we're going to have an increase in the cost of goods sold, the expense related to us selling the inventory. Therefore, the net impact on the income statement is going to be the sales price, this amount, not including the sales tax, minus the cost of goods sold. Also, we're going to have a subledger for the accounts receivable, breaking it out by customer, Mr. Anderson, because we need to know who we have to collect from. Also, we're going to have a subledger for the inventory, breaking out not only the dollar amount, but the decrease in the units of inventory according to a flow assumption of first in, first out. So you can see there's actually a lot going on here. Okay, one more thing on that sales tax I want to point out, because if you're a bookkeeper, you will at some point get a question most likely from a client that's going to say, hey, look, I'm paying all this money in sales tax. I don't see it on the income statement. Why don't I get it on the income statement? Because for taxes, I want the expense because that's equivalent to a deduction for income taxes. And again, the answer is, well, yeah, that's because the sales tax is off income statement, meaning you didn't record it in revenue on the income statement. It increased the liability. And then when we paid it, it went off the balance sheet account of the liability. You can imagine it being set up the other way. You can imagine they set it up as though we increased revenue by $3,622, including the sales tax, and then you have an expense of the sales tax of $172.50, which would bring the net income down to the same area. That possibly would be more honest because the sales tax kind of does fall on top of the business owner. The business owner has to charge the sales and then pay the sales tax. But from the government standpoint, they're trying to say the sales tax isn't on the business, the sales tax is on the customer. And therefore, both the income and the payment of the sales tax is off income statement, not part of the revenue or the expense, but should be on the liability section of the balance sheet. Also, just realize that the invoice form itself is a bill to the person we're giving it to. So remember that kind of issues with the side of the table we're talking about when we get specifically into forms, which is a more defined definition than we might use in normal parlance. Meaning, if I got an invoice from the phone company, I might call it an invoice, I might call it a bill. But when I enter it into the system, if I'm paying it, it's going to be a bill, or I might pay it with an expense form. If I'm sending out the invoice, I call it an invoice, even though the person receiving it's going to call it a bill, even though it says invoice on it, because to them, it's a bill, right? From a data input standpoint. All right, so we could save it. We can save and send it, which is what we would typically do if we were sending it out. But I'm just going to save it here, and then let's check it out and see if it did what we would expect it to do. I'm going to say let's close it. Let's go to the balance sheet and run the report to refresh it. We didn't go into the checking account, but rather the accounts receivable has increased. So let's go into the AR accounts receivable and check it out. There's our invoice detail, 116 Anderson. All right, let's go into that one, and that should take us back to the source document, which is, of course, the invoice. So the invoice here went into accounts receivable for the full amount, $3,622.50. That amount here, $3,622.50. Great. Let's go back. The other side, finally go into the income statement. We're finally generating some money here, some revenue. So if we go into the income statement, we see on the sales side, 3450, noting that amount, once again, doesn't include the sales tax. They put the three line items on separately, but I can tell they come from the same invoice because of the invoice number. If I go into it, 3450 is the total, and that's the amount of the total not including sales tax. 3450, here are the individual amounts included, which are not including sales tax on each of these line items. Let's go back. Then the sales tax, where is it? It's on the balance sheet. It's under the liability section because we have to pay it to the people shaking us down, which of course is the state of California. So they put it under California Department of Tax, which is kind of funny. You would think it would be called sales tax payable or something, and then have the sub accounts maybe of the California Department. This is who you're paying. This is kind of like the vendor, but we can go into that. There's the 172. It put it on there with those two line items. So there's the sales tax calculation. It's in two line items because I believe we imagined that we had to pay for the state and then the local. So we had actually two institutions that were paying for the sales tax. And we know that inventory is going down. So inventory is going to be right here. If I go into inventory, then we know that the inventory should be going down. So here's the same invoice number. There's 4 of them because we have to track this on a first in, first out method. These amounts here, like this 400, is not on the invoice, but well, it's on this one, but the 400 was tied to someone. They're not on the invoice because the invoice is going to give us the sales price, not the cost. So let's go back on up and close this up. So these amounts weren't all on the invoice. Okay, so then let's go back And then the other side's going to the profit and loss report on that one. That's in the cost of goods sold because we're tracking the invoice on a perpetual inventory system. So there's those amounts on the cost of goods sold. Let's go back. What's the net impact on net income? The income, not including sales tax that we're going to receive, minus the cost of goods sold. That gives us the net income, the difference, the 690, noting that we're recording revenue even though we haven't yet gotten paid because it went into accounts receivable and we have to collect on it still. All right, see, there's a lot going on, and that's not all. If I go back to the first tab, we also need to track the accounts receivable by who paid us, by customer. Let's go to the first tab to do that. Let's go into the reports. Let's just look at it from a subledger perspective first. I'm going to scroll down to who owes you, and let's just go into the customer balance detail, right click, and open the link in a new tab. I'm going to pull that tab to the right, pull it to the right, let it think a bit, close up the ham boogie. And so if I run it to refresh it, we can see now Mr. Anderson is here. And there's the invoice that we just added. So Anderson has 2 invoices outstanding, the total amount being $24,122.50. That should tie out to what's on the balance sheet. So here's $24,122.50. So notice it's important to have that subledger because if I go into the AR detail here, it gives us the detail by what, from a book standpoint, would be the general ledger by date of transaction. But that's not good. We need also to see it by who owes us the money so we can collect on it. So let's go back. Now, normally we would track who owes us the money internally in what I would call the customer center or the sales tab. But let me look at that in a second. First, let's also look at the accounts receivable, which is the inventory. We have a subledger for inventory, breaking it out not only by date of transaction, not only by dollar amount of the inventory, but by unit of inventory. Back to the first tab. Let's see if I can find it this way by scrolling down. I want to look for the inventory. It's in sales and customers. And let's right click on the inventory valuation summary. Open a link in a new tab. I'll drag it to the right so that we have it over here. Let it think a bit, close up the ham boogie, change the range to 01/31/25, the end of January. So now we've got the inventory and the quantity on hand, as well as the amount, 44,180. That 44,180 should tie out to what's on the balance sheet, the 44,180. Now remember, the inventory is possible to be thrown out of whack because it's possible to enter something to the inventory asset account without adding an item, whereas that's not typically the case with accounts receivable. In other words, accounts receivable and the subledger breaking out accounts receivable by customer usually can't be thrown out of whack because QuickBooks won't let you post something to accounts receivable without adding a customer, typically. All right, let's go internally. Let's go to the tab to the left. Let's go to the sales tab and track the invoice as we normally would because now we have to collect on the invoice. We can do that closing the hamburger by either going to the sales here and check out the transactions by invoice. And then I have the invoice and I have all status or open. Typically, I'd be looking at the open invoices here. There they are. More likely, however, if we're looking for the invoices, we'll go to the Invoice tab to look at the invoices where we have the quick filter up top, overdue, not deposited, or not yet due. So we can filter this way. So here's the overdue here, or I can say unpaid. Let's just take a look at all the unpaid. There's our invoices. Or we can go to the customer and search for it this way and look at our customers. And I have overdue, 4 overdue invoices, 4 open invoices. So I'm going to go to the open invoices, and there is our invoices. Now we might set up a system in our settings to make sure that we collect on the invoices, possibly sending out a repeat of the invoices if we're not paid in a certain time frame. We can send out another invoice. So if I go into Anderson here, and then there's our invoices. So we can receive the payment. If I select the drop down, we can duplicate, send it again. So in other words, we might want to have a system where we send out the invoice if we haven't been paid on them, in 10 days or something like that. And then after it becomes overdue, if we still haven't been paid, we might set up statements to have automatic statements that will go out possibly on a monthly basis for overdue invoices or something like that, so that the statement will calculate multiple invoices, such as would be the case in this system where Anderson owes us 2 invoices, and we might have the statements sending out a summary of those invoices that are due. So if I hit the plus button here, you have your statements, which are going to be here. That'll give a summary of all the outstanding invoices to the customers to help to collect on them. All right, so once we have the invoice, then of course the next step is going to be we're going to receive a payment on it, which would typically be the next item, which we'll do in a future presentation. But just note that this is basically kind of like the subledger. And so instead of us actually creating the subledger as a report, we're typically going to work internally in the sales tab here. This is the sales tab under the customers or invoices to be tracking the invoices and trying to collect on them. All right, let's do another invoice. Otra vez, another one. Más rápido. Do it faster this time. Let's hit the plus button. We're going to go into the invoice. And this time we're going to go for Jones Guitars. So I'm going to type in Jones Guitars. We already have Jones set up as a customer, so we're good to go. There's where we would email it to them. Here's bill to Jones, the location. So we'll keep that as is. The invoice number populating automatically. We'll keep that as is. Net 30 being the date. We'll keep that, or when we expect payment from the date of the invoice in 30 days within the date of the invoice, which we're going to say plus button 17. So 117 plus 30 days comes out to 216.25. So we expect to be paid by 216.25. All right, so what are we selling this time? Let's tab through this thing. We're going to say, so we're going to say that we're selling a what's going on here? GIUSA. So that's a Gibson USA. There's the description. Here's the quantity that we have on hand. We're just going to sell one of them. They cost us $380. It is taxable, so that is fine. And then the next one is going to be an ELP. So that's that's the one we sell all the time, the ELP. And we're going to say there's 66 of those. We got a lot of those. We're going to sell 8 of them. And they cost $500, so that comes out to $4,000 total. So now we have a total down below of the $4,380. I'm going to calculate the sales tax by selecting the drop down to do our generic sales tax calculation of the 5% for our practice problem purposes, noting that usually you'd be using like the automatic kind of sales tax, but again, I'm going to manually adjust it so it has a type of consumption tax. And all right, so what's this going to do? It's an invoice. So the invoice is going to increase the accounts receivable. The other side's going to go to revenue. So the invoice is going to increase accounts receivable by $4,599, including the sales tax. The sales or revenue on the income statement is only going to go up by the $4,300, not including the sales tax. The sales tax of the $219 is going to go on the balance sheet liability under sales tax payable to the person that we pay, in this case, California Department of so on and so forth. And the invoice inventory is going to go down not by the $4,000, but rather by the cost, which the system knows because we entered it with the items. And the cost of goods sold expense account is going to go up for that same amount of the cost of the inventory. The net impact on net income, therefore, will be the sales price, not including sales tax, $4,380, minus the cost of goods sold, impact on net income. And the subledger for the accounts receivable will show the accounts receivable broken out by customer. In this case, was it Jones Guitars? And the subledger for inventory will break out not only the dollar amount, but also the units of inventory. Notice I make a practice of trying to envision what the journal entry will be, the accounts impacted, with every form. I recommend doing that because that, again, makes you involved, engaged in the process. Because what we want to do is, of course, understand the process so we can fix problems. Otherwise, you can just do the data input, could be done by anybody almost electronically these days, right? So if you're doing the data input, what you want to do is spend your time thinking, okay, what is this actually doing so that I can be more useful on other parts of the system, which is going to take more more understanding of the system, right? So if I can actually say what this is doing, that's going to make me more useful, right? So I'm going to say save and close, and then I'm going to then go to the balance sheet and say, okay, let's run this thing. Let's go into the accounts receivable, drilling down on the AR accounts receivable. We see there's Jones Guitars. There's the full amount, the 4599, which is the amount that includes the sales tax that's increasing the accounts receivable, including the sales tax, closing that out. And then I'm going back. The other side went to the profit and loss or income statement, run it to refresh it. We have the sales going up, should be going up by the amount that doesn't include the sales tax this time. Notice it still included 2 line items, even though we only had 1 line item in the system. I think that's because of the way it's trying to track the first in, first out inventory method. But if I go into here, Jones Guitars, then we see, now wait a second here, hold on a second. Did we have 2 line items on that one? We did have 2 line items. That makes sense. Sorry, we have 2 line items. So that was the 4380, which was the 380 and the 4000. So if I close that out, we can see here the 380 and the 4000, which do not include the sales tax. Let's go back and then go back to the balance sheet. The sales tax is going to be down here under the liabilities. So now the sales tax has been going up. We're collecting, or we're going to collect, these amounts broken out into 2 items for state and locals, the way we set up our sales tax. Going back, and then we know that inventory is going to be going down. Inventory asset, if I go into that one, inventory is going to be going down for the cost of the inventory. So here's the 2 Jones Guitars. Notice that the 304 and the 3200 amounts are not on the form. Right? These 2 amounts are different. Why? Because this is the sales price, not the cost. So I'm going to close this out and go back. The other side of that is going to the profit and loss, and that's going to be in cost of goods sold. And so we're going to go down here, and those are those 2. Remember, it's useful to think about like the invoice, if you're dealing with inventory, as 2 separate journal entries, because the 2 journal entries kind of reconcile. So you can think about the sales side and then the invoice side, right? The accounts receivable and sales side, accounts receivable goes up, sales go up, and the difference is the sales tax. And then the inventory side, inventory goes down, and the related account is cost of goods sold on that side. All right, so let's go back on over. And then, so the net impact on net income is the sales price minus the cost of goods sold. Also, if I go back to the balance sheet, the accounts receivable also needs to be broken out by customer, which we could see on the subledger. So if I go to the subledger, run it, that's for inventory. Let's go to this subledger and run it. So now we've got Jones Guitars. So here's the 2 that Jones Guitars owes us, breaking it out by customer. The total of the subledger broken out by customer, 29,721.50, should match what's on the balance sheet. Okay, Paso 28,721.50, 28,721.50, and the subledger for inventory. It's going to break out the inventory not just by dollar amount, but by inventory item. Going to it, subledger over here, run it. So now we've got the new quantity of inventory, which are now populated. And if I convert that to the dollars, using first in, first out, I believe is what it's using, we get the 40,676, which should tie out what's on the balance sheet, 40,676. If I go to the first tab, I can then go into the sales tab, and I could go into the invoices, for example, closing up the hamburger, and we can see the unpaid invoices now includes the Jones Guitars. We have the 2 invoices for Jones Guitars, and if I go into the customers, I can then take a look at the 5 unpaid invoices, which include Jones Guitars, has 2 open invoices going into those. And there's my 2 invoices for Jones Guitar, so I can track them internally, following up on them, sending out another invoice if necessary, just the same invoice to remind them that they owe us money, or we can send a statement out periodically, which will combine the 2 invoices into one statement, reminding them that they owe us money. All right, so that's the general idea. If I go back to the balance sheet, this is where we stand now, so you can kind of check your numbers to our numbers here. Now we do have something on the income statement. Here it is. It's easier to check these numbers on the trial balance because that'll put everything on one sheet. So let's go back to the first tab, open up the handbookie. Let's go down to the reports. I'm just going to type in up top the trial balance and say, let's do that. Closing up the hamburger. I'm going to make this as of 01/01/25 to 01/31/25. Run it to refresh it. So now we have basically the balance sheet on top of the income statement. So you could check each of these accounts to here, and if your numbers tie out to our numbers, then we're on the same page. If not, then you could increase the date. It's often a date range issue. Increase the date to past the date that you're working on the problem. See if the numbers change. If they do, drill down on the number, get to the source document, change the date on the source document. Now, also just realize that as we build this trial balance, you'll notice that the balance sheet stops down here in opening balance equity or owner's equity. And then down here, we have the 2 income statement accounts. 7830 and the 6264. Those are the 2 income statement on the profit and loss. So 7830 and 6264. Boom. So if I go back on over here, so that's, note that on the balance sheet, if I go back to the balance sheet, you'll see those 2 combined on the equity section at the bottom of the balance sheet as net income. So there's the net income. That net income will roll into the retained earnings at the close of the period. But remember, it doesn't do it monthly. So like because QuickBooks will do the closing process for us automatically, but not monthly. So if I ran this for 02/01/25 to 02/28/25, run it, then I scroll down. You would think the net income should have rolled into the owner's equity or retained earnings, but it didn't, right? And that's because the system sees the closing process only done on a yearly basis. So in other words, if I ran this for 01/01/26 the next year to 01/31/26 the next year and run it, then it's going to roll it. Net income is now gone. It rolled it into the owner's equity. Similarly, over here on the trial balance, you can't really change it on. It's not going to. This isn't going to go away on a month-to-month basis. In other words, if I change this to 02/01/25 to 02/28/25, following the month of data input, you would think that these 2 accounts would go away and it would be combined into owner's equity. But that's not going to happen until the next year. So in the next year, if I went to 01/01/26 to 01/31/26, then the income statement is gone and it rolled it into owner's equity. So just something to keep in mind. I'll bring it back to the current period, 01/01/25 to 01/31/25, run it to refresh it. This is where we stand, balance sheet on top of the income statement.